Welcome back to Investing Talk Podcast.
Today we're looking at Microbot Medical.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. Microbot Medical is it's a fascinating and I'd say high-stakes situation.
High stakes is right.
We are looking at a classic pre-revenue medtech play. It's focusing all its energy on commercializing its flagship product,
Yeah.
the Liberty endovascular robotic system.
Okay.
The core thesis here is a big one. It's a highly differentiated, first mover product aiming for a massive inflection point.
And when we talk about pre-revenue, we have to look at the scoreboard today. For you, the listener who might be looking at this company's market cap, you have to realize this valuation isn't built on today's profits, is it?
Not at all. And we have to start there with the financial reality. The company is squarely in that investment phase.
Meaning they're spending money.
A lot of it. For Q3 2025, net losses came in around $3.6 million. Right. They've got negative free cash flow. They're burning cash, but that's a calculated cost. It's the price of admission, really, for building the commercial infrastructure you need for a global launch.
So the market is valuing this small cap, even with a negative PE of around -4.5, purely on the potential success of this one product. So what makes this Liberty platform worth that kind of risk? What's the moat?
It's not just that it's a robot, it's the structural differences. When you hear surgical robotics, you usually think of these massive, multi-million-dollar capital consoles, right?
Right, huge machines.
Liberty just breaks that mold. It is the only FDA-cleared, single-use, remotely operated robotic system specifically for peripheral endovascular procedures.
That distinction, peripheral endovascular, is key. But let's dig into that single-use concept. That sounds like a massive cost saver for hospitals.
Precisely. The disposable design completely flips the hospital economics. It minimizes their fixed overhead because it just integrates into existing catheter labs.
Yeah.
No multi-million-dollar upgrade cycle.
But the real game changers are probably the clinical advantages, right? For the staff.
That's where it gets really interesting. It has to be more than just cost.
So tell us more about those drivers, because for massive adoption, it has to make the job easier or safer.
It does both. So think about a physician standing in that cath lab for 6, 8, maybe 10 hours for a long procedure. The physical strain is incredible. That leads to clinician fatigue.
And the remote operation helps with that.
It addresses it directly. But the most important element is radiation protection. Using this system drastically reduces the lifetime radiation exposure for the clinical staff. Over a 30-year career, that risk mitigation is just invaluable. It's a foundational safety improvement.
That has to shift the risk calculation for the entire hospital administration. And we're not talking about a small market here. What's the potential scale?
This is where it gets really compelling. The initial addressable market. It's about 2.5 million peripheral endovascular procedures annually in the U.S. alone.
2.5 million.
Wow. So if Microbot captures even a single-digit percentage of that market, the revenue inflection would be, well, transformative. It would instantly justify those bullish targets we're seeing.
Okay, so they have the product. How are they getting it to market?
They're being very strategic. They're in what's called a limited market release, or LMR.
Why restrict access when the market is that big? Couldn't that just delay revenue?
It seems like it, but it's a very smart risk management step. The LMR is active in high-volume U.S. regions right now. It lets the company refine the workflow, gather data, optimize costs, get everything polished before a mass launch. They're de-risking the process.
And we've already seen a major validation point, which is so critical for a company at this stage.
You talk about Emory.
Exactly. A big hospital adopting the tech is the stamp of approval everyone looks for.
And they didn't just buy one. Emory University Hospital launched a dedicated endovascular robotics program built around the Liberty platform. That provides incredible validation and creates a reference site for other hospitals to look at.
So this is all building towards something.
It's all building toward one single massive event horizon, the full commercial launch. It's planned for the Society of Interventional Radiology, the SIR conference, in April 2026.
April 2026. So you need to circle that date.
Absolutely. Institutional interest, adoption schedules, analyst models, it all revolves around that April window.
Okay, let's pivot to the money. Analysts are incredibly bullish. But how does the company fund this burn rate until April 2026? When you see negative earnings, solvency is always the first question.
That's the key question. And the good news is they have strong liquidity right now. They have the cash reserves to fund the launch prep and manage that negative cash flow. This liquidity is the buffer that lets everyone focus on execution.
And analysts have definitely taken note. The sentiment seems almost universally bullish, and it's all tied to Liberty's adoption.
It is striking. We've seen multiple firms point to really aggressive price targets. They're ranging from around 550, which would be about 149% upside from recent levels,
It was already huge.
all the way up to a highly ambitious $12. That implies up to 594% upside potential.
That's massive. Now, if we look at the trading action right now, what does the technical picture tell us?
Well, technically, the stock is in a consolidation phase. Short-term indicators like the EMAs are flashing bearish, which is expected, but the stock's been trading in a very tight range, sort of stabilizing around 208 to 239.
So what does that mean?
A lot of analysts see this as an attractive accumulation phase. The price reflects the current risk, but it seems to be building a floor right before those huge 2026 catalysts.
Okay, that covers the near term. Let's zoom out again, past the launch. The real moat here is the business model you mentioned. Explain how the disposable nature turns into an economic powerhouse.
Right, it's that classic razor and blade model, but really optimized. The hospital makes a manageable initial investment, but the sustainable high-margin revenue comes from selling the disposable components for every single procedure.
So the revenue is based on procedure volume.
Exactly. It's scalable, it's recurring, and it creates a structurally better margin profile than selling giant, expensive machines every few years.
And are they protecting this unique tech?
They are, proactively. They're expanding their global intellectual property. They just got a key patent in Japan, which adds to existing ones in the US, China, and Israel.
So that lays the groundwork for global expansion.
It does. It constrains copycats. And it's crucial for any potential ex-US deals or partnerships down the line.
And when you have unique IP, a small cap, and a disruptive product, the speculation inevitably starts. Any credible rumors about an acquisition?
The speculation is definitely swirling, though nothing is confirmed, of course.
Yeah.
But the nature of the IP makes Microbot a very plausible strategic target.
For a bigger medtech player.
Right. If a large imaging or medtech company wants to instantly get into the single-use robotics game, this company offers a very neat little package. It's like a call option layered on top of the organic growth story.
That's certainly compelling. But we have to be clear about the downsides. For you, the listener, you have to understand the high risk here. What is the single biggest threat?
It's pure and simple. Execution failure. This is a single product story. If they fail to execute the Liberty launch, or if adoption is way slower than expected, well, that's the biggest threat to the whole valuation.
But the company is managing that risk, aren't they? They're not just throwing a Hail Mary.
They are actively mitigating it. One, FDA clearance is done. That's a huge hurdle. Two, the controlled LMR approach is designed to learn and refine the rollout. And three, the Emory adoption already reduces that initial clinical hurdle for other hospitals.
Let's press on the other major risk, financing. With negative cash flow, how high is the risk of dilution for current investors?
The potential is high, and you have to acknowledge that. Future capital raises are likely. That's just the classic challenge for any scaling med tech company. You need cash to grow.
So how does success mitigate that painful dilution?
Success changes the terms of the deal. Their strong liquidity now gives them runway to hit key milestones. If they hit those targets, the cost of any future capital raise drops dramatically. Investors will pay a premium for a proven, de-risked story. Success is the best insurance against bad dilution.
Okay, so to bring it all together.
To summarize the full picture, this is an asymmetric bet. It is inherently high risk, given the pre-revenue status, but it offers equally high reward based on the Liberty system, the disposable model, and the staggering size of that market.
And if you're considering this opportunity, what's the right time frame? This isn't a quarterly earnings play.
Absolutely not. This is an investment in a commercialization story. The recommended horizon is a multi-year hold. We're thinking 18 to 36 months. You need that time to capture the revenue ramp after that April 2026 launch and see the adoption curve play out.
The question you need to mull over is this. Can the ergonomic and radiation safety advantages of this unique single-use robot break the hold of traditional, expensive capital equipment in 2.5 million procedures annually?
A question that could define the next 3 years for this part of the industry.
For more insightful analysis on disruptive technology and financial opportunities, make sure you subscribe to the podcast wherever you listen. We'll be back next time with another analysis.